Everyone is here. We're ready to go.
Okay, perfect. I'm going to share my screen here. So this, I thought this was important to do just for the sake of shedding some light on how interest rates and stuff work, and also to just arm you with a little bit more information on what's going on in the market and how things work. Let me just get in here. Okay. Okay. Oops. Sorry, I am not very tech savvy. Okay, so I'm going to share my screen here real quick. I've got just a few slides. I don't imagine that this is going to take an hour and a half, but entirely up to you guys if you want to ask questions and things like that. I'm not going to get into specifics of any types of loan programs or actual interest rates. This is really just an informative educational piece on how the bond market works and what we're looking at as lenders. So I'm going to share my screen here. Okay, can everybody see that? Hopefully. Okay. All right, so I'm going to get started here. And at any point, we're a small group.
Hold on. I'm going to try and find the meeting ID and password, and maybe you can just kind of get around it and join directly through that instead of having to log in. So let me find that, and I will give you a call back. All right. Bye.
Hey, Brian, if it helps, I just logged in via the emails that was sent out from
that should be all right.
Yeah.
But how does that work?
It's just a link. It's just like any other team meeting.
Can you join with meeting ID?
I had a hard time logging in initially too.
There's someone that
okay, should I pause for a second, or are more people joining? Hello, Brian, Carly, somebody. Okay, I'm gonna just keep going. Okay, mortgage rates uncovered and explained. Like I said, this is not to go through specifics of qualifications, programs, actual rates, or anything like that. It's really just to talk about the market and what's going on, what we're seeing right now in this period. Okay, so there's a lot of factors that affect actual mortgage rates. There's obviously a lot of information online. Clients and buyers can Google search mortgage rates, and it can be deceiving, and it can be misleading, it can be overwhelming. You know, if somebody pulls up or Googles mortgage rates, a very generic scenario or interest rate pops up. And even when somebody goes online and plugs in their information, it's also very generic. There's a lot of things that actually affect interest rates. Not everybody qualifies for the same thing. Not everybody qualifies for the same program. There's a lot of things that go into it. In addition to that, there's a lot of pieces that affect interest rates and mortgage bonds. Things like inflation, that's obviously a huge buzzword right now. We're all seeing it. Cost of goods are rapidly going up, and the value of the dollar has declined. And that's because there's more money in circulation. And what the Fed is trying to do currently is essentially try to pull some of that money off the streets. It got a little crazy, a little aggressive during COVID and with stimulus and all this stuff. there's too much money on the street. So the value of the dollar has gone down and the cost of goods has gone up. So inflation is a big factor. The gradual upward movement of prices due to inflation is a reflection of the overall economy and a critical factor for mortgage lenders. Inflation erodes the purchasing power of dollars over time. Mortgage lenders generally have to maintain interest rates at a level that is at least sufficient to overcome the erosion of purchasing power through inflation to ensure that their interest returns represent a real net profit. For example, if a mortgage rates are at 5%, the level of annual inflation is at 2%, the real return on the loan in terms of purchasing power of the dollar to the lender only gets back 3%. Therefore, mortgage lenders carefully monitor the rate of inflation and adjust rates accordingly. Does anybody have any questions about inflation? Does that make sense to everybody? The next thing affecting interest rates and please note too that they fluctuate on a daily basis. Mortgage rates work very similar to stocks. They are bought and sold. Mortgage bonds are bought and sold on the open market. So they fluctuate and they're volatile, and they change daily and sometimes multiple times a day, for better or for worse. And I think that's really important for your clients to know as well. They can Google something today and it could look a lot different tomorrow. So keep that in mind. And when you're talking to your clients, to your buyers, let them know that it is very much a fluid situation. The next thing affecting how interest rates go up or go down is the rate of economic growth. So lots of indicators in the economy. Economic growth indicators such as gross domestic product or GDP and the employment rate influence mortgage rates. With economic growth comes higher wages and greater consumer spending, including consumers seeking mortgage loans for home purchases. That's good for a country's economy, but the upswing in the overall demand for mortgages tends to propel mortgage rates higher. The reason, lenders only have so much capital to lend. In a slowing economy, the opposite occurs. Employment and wages decline, leading to decreased demand for home loans, which puts downward pressure on interest rates offered by mortgage lenders. So we're in a really interesting time right now, and a lot of experts are leaning and alluding to the fact that we're steering into a recession. Instantly everybody thinks, recession, it's doomsday and we're going back to 2007, 2008. And that's not necessarily the case. We've all seen the news about the Fed's meeting and Fed minutes and Jerome Powell trying to slow down the inflation. All signs point to a recession, and generally speaking and historically speaking, that is a good thing for real estate and for interest rates. Historically, as we lean into a recession, interest rates drop, and that goes into the next factor with interest rates. The Federal Reserve monetary policy. The monetary policy pursued by the Federal Reserve Bank is one of the most important factors influencing both the economy generally and interest rates specifically, including mortgage rates. The Federal Reserve does not set the specific interest rates in the mortgage market. So we've all been paying attention. The Feds just did a 0.5% rate hike and a 0.25% rate hike, and are expected to do additional hikes later on this year. That is not directly, they're not talking about increasing mortgage rates directly. When the Fed increases the prime rate, it directly impacts short-term borrowing. And again, they're trying to get money off the streets because of inflation, because the value of the dollar has gone down while the cost of goods has gone up. So in order to do that, they're increasing the rate of short-term money. When the Fed increases rates by 0.5%, that doesn't mean that mortgage rates go up 0.5%. It does have impact on it, however, because again, we're talking about inflation. We're talking about general monetary policy of the Feds, which impacts the value of the dollar, the rate at which banks borrow money, the rate at which consumers borrow money. It's all intertwined and related. But again, when the Fed says that they're increasing rates by 0.25% or 0.5% or a full percentage point, that doesn't mean that mortgage rates go up by that much. The actual economic policies and other factors play into the actual mortgage rates and how those fluctuate. Generally, increases in the money supply put downward pressure on rates, while tightening the money supply pushes rates upward, which is exactly where we're at right now, right? The Fed is increasing the prime rate in order to tighten the money supply. That's why we're seeing rates go upwards. Does anybody have any questions so far? Okay, the next factor, the bond market. So we've got, everybody knows the stock market, and we've also got the bond market. This directly impacts mortgage rates. Mortgage bonds and mortgage-backed securities are investments. They are investments just like a stock would be, or if you have money in, say, a mutual fund with multiple stock investments and so forth. A mortgage-backed security or a mortgage-backed security is an investment just like that. You're buying into basically a mortgage. If you're an investor, and let's just say you're buying a 30-year mortgage note, you're investing your money in that long-term bond. In that case, it's a 30-year mortgage bond, right? The yields available from these securities must be sufficiently high to attract buyers. So mortgage bonds, just like stocks, there's a supply and demand. When a stock is in really high demand, the value of it is more valuable. When people start selling off a stock, the value of that stock drops. The same goes for mortgage-backed securities. As investors purchase mortgage-backed securities, that's a good thing, and that generally means that interest rates are going down. When investors are pulling out of mortgage-backed securities and selling them off or not buying as many, interest rates go up. Where we are right now with such a drastic change since, the beginning of the year in terms of interest rates and so forth, the Feds have cut back and tapered on their purchase of mortgage-backed securities. Other investors have also pulled back on their purchase of mortgage-backed securities. We've seen such a drastic increase over the last couple of months. Just logistically, if you think about it, if you're going to buy a 30-year mortgage bond today at the current interest rates today, you're investing and you're hoping that you're going to see a return on that. In all likelihood, where things are now, there will be at some point some relief from where interest rate levels are today. Could be a year, could be 18 months, could be 2 years. We don't exactly know. But remember, I said, as we lean into a recession, we'll likely get some relief. It's a good thing for interest rates. It's a good thing for real estate. If you're an investor purchasing a mortgage-backed security today with a 30-year mortgage note, in all likelihood, that note will get refinanced and you'll never get your investment and your profit isn't as high as what you'd hope for, right? Whereas somebody that got an interest rate a year ago at whatever it was, 2.75 or 2.875, whatever it was a year ago, the likelihood that that investor who purchased that mortgage bond, let's say, holds that note for a long period of time is very, very, very likely. So the next piece, part of this equation is the fact that the government bonds and corporate bonds offer competing long-term fixed income investments. The money you can earn on these competing investment products affects the yields the mortgage-backed securities offer. The overall condition of the larger bond market indirectly affects how much lenders charge for mortgages. Lenders have to generate sufficient yield for mortgage-backed securities to make them competitive in the total debt security market. So again, if an investment doesn't make you money, do you want to invest in it? Right? It's a supply and demand issue, just like real estate inventory is. It's a supply and demand issue. The less supply, the more people are going to pay for it. The more supply, the less people need to pay for it. So one frequently used government bond benchmark to which mortgage lenders often peg their interest rates is the 10-year Treasury bond. Typically, mortgage-backed security sellers must offer higher yields because repayment is not 100% guaranteed as it is with government bonds. So there's, of course, like I was talking about before, investors making money and so forth. There's risk involved with the bond market and being an investor in the bond market. And so that's all taken into consideration too. And a big dictator of which direction rates go. Again, they work similar to stocks and other investments. The more people are buying, the better interest rates are. The less people are buying and the more investors are pulling out of bonds, the higher interest rates go. So another factor, we're all familiar with this, housing market conditions also impact mortgage rates in the mortgage market. Trends and conditions in the housing market also affect mortgage rates. When fewer homes are being built or offered for resale, the decline in home purchasing leads to a decline in the demand for mortgages and pushes interest rates downward. A recent trend that has also applied downward pressure to rates is an increasing number of consumers opting to rent rather than to buy. Such changes in the availability of homes and consumer demand affect the levels at which mortgage lenders set their loan rates. Now, we're in a weird time because generally speaking, when there's more inventory is where we might see higher interest rates. Things are a little bit skewed now because the inventory problem in the housing market is not solving itself. There's obviously a whole new generation of buyers that have come into the market, the millennials, and there's not enough supply to meet the demand. The economic piece of the equation is what is ultimately driving the interest rates. So we have incredibly high housing market conditions and very low supply, while we're also seeing interest rates climb. So interesting time. The bottom line here is supply and demand by investors. Mortgage rates are tied to the basic rules of supply and demand. Factors such as inflation, economic growth, the Fed's monetary policy, and the state of the bond and housing markets all come into play. Of course, the borrower's financial health will also affect the interest rate that they receive. So do your best to keep yours as healthy as possible. Again, I talked about this a little earlier about the difference between each client. You know, somebody that's got a ton of cash over at JP Morgan or Merrill Lynch or wherever, that has great credit and tons of money and so forth, is going to look different than somebody that doesn't have great credit and is putting a lower down payment down. Property types also play into it. Single family is different than a condominium. Single family and condos are different than 1 to 2 units. 1 to 2 units are different than 2 to 4 units. So all of these things come into play. Not everyone's financing is going to look the same. So I think it's really important when you're talking to your potential buyers or existing buyers, to sort of set that expectation too. Obviously people are out there, they're shopping rates and shopping programs and shopping lenders and banks and so forth. It's really important that they know that kind of a little bit how the market works and how rates work and what drives the rates, but also know that their qualifications absolutely contribute to what sort of program and rate they're going to get. So inflation, I'm sure you all know. I thought I would just throw in a quick little definition slide of inflation, because it's all over every channel of TV. We see it in gas prices. We see it in consumer goods and car prices, and everything is higher, right? The cost of everything is higher. By definition, inflation causes the US dollar to lose its value relative to a basket of global currencies. As the US dollar loses value, the value of things denominated in US dollars falls too. This includes mortgage-backed bonds. So obviously, if you have $1 and you're buying a mortgage-backed bond for $1, if that $1 actually isn't worth $1 and it's actually worth like 75 cents, that $1 you're paying for that mortgage bond isn't worth that either. So just to put it in basic terms, that's what's happening. That's why we're seeing the rates move and the market the way that it is. Wall Street divests itself of mortgage-backed bonds, adding to the market supply. This leads the market price of mortgage-backed bonds lower. As mortgage bond prices fall, mortgage bond yields rise. These bond yields are the basis for mortgage rates. Rising mortgage rates increase the inflationary pressure on the US economy. So, you know, it's certainly up for discussion, but I think the general consensus with a lot of professional economists and so forth, the Fed should have done something sooner about the inflation problem. Now they're digging themselves out of a hole, and obviously it's creating pressure on interest rates and cost of goods and all kinds of things. So does anybody have any questions about this? And let me also note too that I'm sure you all saw last year, it was big talk. The Feds were purchasing mortgage-backed securities and mortgage bonds for quite a long time during the entire period of COVID and lockdown and all of that stuff. The Feds were purchasing mortgage-backed securities, and a very large amount of mortgage-backed securities. That was also helping to keep rates low. Again, like I was talking about, as investors purchase more mortgage bonds, it drives interest rates down. As investors pull out of mortgage bonds and sell their investments, it then drives mortgage rates up. So the federal government, if they're buying trillions of dollars worth of mortgage-backed securities, and all of a sudden they are tapering off their purchasing, that also impacts the direction of interest rates. So in addition to all of these economic factors and just sort of how rates work as a security, as an investment, there's also a lot of other factors that I briefly touched on that I think is important for your clients to also know, is how a lender might come up with interest rates. Again, credit scores factor in, the amount of down payment factors in, Is it a primary residence, a second home, or investment property? The type of property, is it a single family, a condo, a multi-unit? What does that look like? That all plays into it. The amount of the loan, there is definitely a difference between a $500,000 loan and $1 million loan. There's a difference between a $500,000 loan and a $950,000 loan. That also plays into it, and it plays into available programs. Different programs have different interest rates. Is it a loan that's backed by Fannie Mae or Freddie Mac? Is it a portfolio type loan? Is it a purchase? Is it a refinance? Is it a cash out refinance? There are so many factors that play into it. Again, when you're talking to your clients, to be honest, the internet is their worst enemy. It can be overwhelming, and people can very easily go down the wrong rabbit hole. Because again, you plug something in online and it isn't applicable to everybody. And then all of a sudden your client or your buyer is wondering, like, how come I don't qualify for this? Or how come, it looks a lot different than what I saw online. So really important, I think, to let them know that it's very individualized on what somebody qualifies for. It's very much based on the entire picture. Does anybody have any questions so far? No? Okay. This is just a little screen grab of sort of the movement of mortgage rates and the 10-year bond. I know we talked about it earlier when you're looking at the 10-year treasury. So anytime let's say you're watching the news and the economic report comes on, anytime you hear 10-year treasury, that is directly related to mortgage rates. So just keep an eye on that. When the 10-year treasury is up, or the 10-year bond yield is up, that means mortgage rates are up. When the 10-year bond yield is down, mortgage rates are down. So you can see here, starting back in February, it a little bit up, and then it came down, and then we've been on a very, very steady increase up since February, since before this actually. But you can see the incline. If we were to go back even further, you'd see the prior year's pattern of the yield being down, and then obviously this pretty rapid increase. I have lots of tools. There's a website that I'm on. I know that I've shared it on the weekly meetings and stuff, to stay up to date on what's happening with the market and what direction things are moving, and really how to just keep a pulse on it. And I get text messages and things like that. There's a lot of really great tools on this particular website that I pay for membership on. I'm happy to share those tools. There's lots of things like, of course, market update. There is a cost of waiting tool. There's a buy versus rent tool. We can plug in any of your clients, let's say, that are currently renting. We can plug in whatever their rent scenario is currently and run some different options of what it looks like over the course of let's call it a 5 or a 10-year period of renting versus owning based on their particular budget. And it's a really great tool to show appreciation, let's say, over the next 10 years, and the amount that they would have paid down their mortgage. And then also it shows, over the next 10 years of paying rent, obviously you're not left with any appreciation of paying rent. So lots of really great tools. I'm happy to share those with anybody that is interested. But I wanted to give you guys a quick little glimpse on what we're looking at least what I'm looking at on a daily basis with the direction of where the market's going. Okay. what moves mortgage rates in the short term? I feel like I'm sounding like a broken record, but mortgage rates tend to fall when US stocks tank, foreign markets tumble, unemployment rises, and inflation is expected to slow down. This right here, mortgage rates tend to fall when that alludes to recession. All of these things, US stocks tank, foreign markets tumble, unemployment rises, and inflation expected to slow. The feds are trying to slow down inflation. That's what's happening right now. Unemployment is not necessarily on the rise. Unemployment rates have been very decent. But that can also change. A lot of small businesses are having a hard time getting and keeping employees because of the cost of wages have gone up, and the cost of really operating a business in general have gone up, supplies and things like that. So when mortgage rates tend to fall, recession, I said this earlier, as we lean into a recession, we are likely to see a break in interest rates. Mortgage rates tend to rise when stocks rise. Foreign markets rise, jobs are easy to get, and inflation is expected to speed up. We're in the speeding up zone right now, which is why rates are going up. The stock market hasn't been doing great, but that is a byproduct of everything else going on economically. Literally, if somebody blows in the wrong direction, the markets react. So really important to keep this in mind, especially when you're talking about buyers who are hesitant about buying. They see the news, they see that rates are up, the cost of borrowing is up. All things temporary. There's at some point, obviously I don't have a crystal ball. I'm not Alan Greenspan either. But at some point there will be an opportunity for people to refinance and drop those payments and interest rates. So we've been here before. I think it was 2019. I think it was the summer of 2019, maybe 2018. We saw a pretty sharp increase. And I'm sure you all remember prior to COVID, we were in the 4%, maybe even a little higher, close to 5s, not that long ago. So there will eventually be an opportunity. If clients are hesitant, all things temporary, get in. Obviously appreciation continues to go up because of the supply and demand issue. The cost of waiting, on the other hand, not getting in now and getting in a year from now, certainly you might have a lower rate, but prices don't seem to be going anywhere because of the supply and demand issue. What is an economic recession? I know everybody tends to freak when we hear recession. Lots of factors. It doesn't necessarily mean doomsday or 2008, 2009. That was an entirely different scenario. That was literally an economic crash because of aggressive lending and people getting upside down and values crashing and so forth. An average homeowner today has an extreme amount of equity, so we don't foresee it. And actually, foreclosures and default rates are at I think an all-time low, as a matter of fact. So a recession is a period of economic decline signaled by an increase in unemployment, a drop in the stock market, and a dip in the housing market. An official recession is not declared until the total value of goods and services in the US, called the gross domestic product, or GDP, has been in decline for 2 or more quarters, so for 6 months or more. What causes a recession? Depending on which economist you ask, the United States is currently suffering through either its 45th or 47th recession. What's remarkable is that no two have been exactly alike. There are, however, characteristics that most recessions have in common. High interest rates, high inflation, or both. High interest rates limit the amount of money available to borrow and can signal the beginning of a recession. Inflation refers to a rise in prices of everyday goods and services we purchase, like groceries, gasoline, and consumer items. Real wages don't buy as much. The term real wages refers to how far our income stretches. For example, if you earn $60,000 in one city, you might be able to buy a home and live fairly comfortably. That same 60,000 is not going to stretch nearly as far in a more expansive area, though. As a recession begins, real wages across the country begin to shrink. Again, the value of the dollar has dropped and the cost of goods goes up. Once real wages begin to shrink, consumers lose confidence. As they realize that their income is not keeping pace with inflation, they stop spending as much, which contributes to an overall slowdown. In fact, one of the reasons the US government passed a $2 trillion stimulus package, this must have been in COVID days, was to keep Americans spending money and the economy chugging along until the coronavirus had passed. So again, I think I said this before, the government was pumping money into the economy to stimulate the economy during COVID and while things were shut down to keep people spending. But as they printed more money, the value of the dollar shrunk. So now, like the example above, $60,000 salary doesn't get you the same as a $60,000 salary did several years ago, because the cost of goods are high and the value of that dollar is not a dollar. Okay, so I wanted to give a quick look. This is just a screen grab, and this isn't based on anything necessarily specific, but I wanted to give a visual on what lenders look at when we're looking at rates and things like that. And of course, everybody's going to have a different system and it's going to look a little bit different, but just, oops, how do I go back? There we go. I wanted to just give you a quick visual on what it looks like. When we plug in somebody's scenario, it's going to be all things, you know, the credit, the property type, the down payment, the purchase price, all of that stuff. And we go in and we plug into our system. When we're looking at this, you see where it says price, the cost, when it says 100, that means there's no cost. There's no cost to the client. There's no cost to us. This means it is straight pricing at what we call par. Anything less than 100 becomes a cost. And you'll see it over here. It directly corresponds as points. So 1/4 point, 3/4 point, 1 1/4 points, 2 points. This is the equation in dollars. This is how that translates in dollars. And this is going to, of course, be based on a specific loan size. Points are a multiplier of the loan amount. But when lenders are looking, let's just say you have a buyer that is they're getting quotes from multiple lenders, and one lender says you're going to get, 4.45 with no cost, or you're going to get 4 1/4 with a 2-point cost. This is the perspective of the lender. That means that without that cost being charged to the buyer, that cost is getting the lender to a whole, getting the lender to that 100. If you're below that 100, it becomes a cost. So anytime your client's like, oh, they're quoting me a 1/4 point or 1/2 point or 1 point, this is what it looks like on the back end. And not that you have to concern yourself with that, but the lender has to get to the 100, or it then becomes a cost to either the lender or to the client. Does that make sense to everybody? It's probably too much information, but I feel like it's helpful because you guys, I'm sure, hear from clients all the time, who tell you what they're getting from a rate and a points perspective.
Where is the part, this is, I don't know if I explained this correctly, my question. When the lender gets their commission, which can sometimes be adjusted during the course of this, where is that showing up in there? Is there an, I mean, not that clearly I would not want you to get commission, but the buyer, right? So where is that the part that you guys play with?
We don't. So depending on who your client is working with as well. So a bank is going to be different than a lender. A lender is going to be different than a broker. As a direct lender, we don't play with our commission. Our commission is built into this, basically. It's built into margins. In order to make us as the lender whole, my commission is included in this, okay? And so anything less than this 100 then cuts into the lender's margin. And I'm not talking specific to Movement, I'm just talking in general to a direct lender, if it's Loan Depot or whoever it is. If it's less than 100, it then cuts into the lender's margin. In that case, depending on how deep the cut is, so like at 0.25%, that lender may be able to go, okay, we'll sack it up and we'll eat the quarter instead of charging it back. If you're talking about a broker, depending on what this looks like on the broker perspective, the broker may charge an upfront point to make their commission. Maybe that upfront point is their commission. It depends. On a banking side too, commissions don't generally change. Like they're not adjusted, and they're typically built in. If
someone's coming and they're saying, okay, this is what my bank offered, this is what this broker offered, and this is what this lender offered, like, and you or one of you wants the business, right? And how can you be competitive, and where does that competition, where do those adjustments come, where you're saying before, between like that 0.25% area, or I'm curious to understand how the numbers work, not that I'm going to tell them these things.
Yeah, it depends. And to be honest, it comes down to margins that are built into price. And whether you're talking about a broker or a direct lender or a bank, it comes down to margins. And so if we're going to price match, let's just say, if we're going to price match a bank, depending on what that price match is, if somebody comes to me and says, oh, B of A is offering me, 4.35 at no cost, at that point, I then have to take it to management and go, management, are you willing to eat, in this case, $11,000 in margin? So it either comes out of margin, or it is the responsibility of the buyer if they're going to buy down the interest rate, if you will.
I'd like to pop in here for a second, Michelle, because in this market, I think the bigger conversation that I would have with that client, if the numbers are, 0.25 point or something, is they will not get the home with Bank of America because they can't close in less than 45 days unless they're with the high net worth division. And honestly, even then they're having trouble. So it's not a matter of selling. To me, it's never a matter of selling Andy per se. It's a matter of confidence that I have in her ability to close when she says she will. And a lot of times I will have clients that say, oh, well, I got approved with Rocket Mortgage for blah, blah, blah.
Mhm.
I can tell you as a listing agent, I'm not going to accept that offer because they can't close. They're the ones that get to the end and they all of a sudden there's all these things that they need and your clients lifted their contingencies because they had to, and they can't close on a loan. So it's a matter, I think it's not just a matter of numbers, it's a matter of understanding, like we want to see our escrows go through.
Well, and I think too, I think it's also important to note too, I mentioned this earlier, that mortgage bonds and mortgage-backed securities, just like stocks, change every day, sometimes multiple times a day, and they can go very drastically in one direction or another. It's really important, you know, when you're talking to a client today and they want to start the process and get pre-approved and start house hunting, what it looks like today might look completely different 2 weeks or a month from now. By the time they identify a property and go under contract and all of that stuff, it might look entirely different. And so, you know, I run into this all the time. People will call and they go, oh, B of A offered me something crazy. And I go, when did you get that quote? And they go, oh, about a month ago. I'm like, a month ago is an entirely different story. I can't compare what you got a month ago with today. That's
Yeah. No, for me, this is sort of like general background info.
Yeah.
So that I know, so that I see, you know, because, you know, the majority, my experience is the majority of buyers are always going to be shopping rates.
Yeah.
No matter what I say, sometimes I'm like, you know, you get what you pay for, you know,
Yeah.
that's always what I say, you know, you're going to get good service from, you know, and that's most important when you're buying your most expensive asset. But sometimes it just doesn't work. And oftentimes I've had people that I have to use my bank, I have to use my investment company or whatever. I mean,
Yeah.
and, you know, in the couple of cases that, you know, we just got in the it was not 30 days, it was like 33, you know, but at that point we're like, we're going to close in a day. We're going to close in a day. Well,
Yes. So,
yeah.
I mean, just for the sake of general knowledge,
Mhm.
if somebody is telling you that they're being charged points to buy down the rate, it's to cover this discrepancy, whatever the discrepancy might be.
Mhm.
They're being charged that in order to make it whole and to get that lender or bank to 100.
I see.
I mean, to be honest, in this particular market, anybody paying to buy anything down is crazy to me. But you know, it's of course anybody's personal decision. The moral of the story is the lender, the broker, the bank, whoever wants to get to this 100. As soon as it's below 100, it then cuts into margins and potentially costs the bank, lender, or broker money, which is why it would then get charged back to the buyer.
Right.
I have a question, Andy, about the lock period.
Sure.
Because I thought it was normally 30 days, but you've got it in here as 45. I've had a couple of clients, because of this massive increase in rates, ask me if they can lock before they've even found a property. And I basically, I thought it was 30 days, and I told them, you know, they're not going to find a property and close on that property in less than 30 days if they haven't even identified the property yet.
Yeah.
That was sort of my thing. But if you're saying it's 45, what is your response to that question?
So lock periods vary by program. Bless you, whoever that is.
Oh, I'm sorry.
That's okay. Lock periods vary by program. So a conventional loan, for instance, or a high balance loan, which are both backed by Fannie and Freddie, those standard lock periods are 30 days. You can do a lock as short as 15 days on those loans as well. You can also increase it and go 45 or 60. As you go up from 30 on a conventional loan, the lock then becomes more expensive. which then relates and correlates with this. This particular scenario here is a jumbo loan. Standard, we have programs that offer a 30-day lock on a jumbo. Some offer 45. It depends on who the investor is. So I didn't even notice the 45-day lock. To answer your question, a buyer cannot lock in a rate until they've identified a property. And that's because when a loan is locked, that broker, lender, whoever is essentially saying, we're going to deliver this as a closed loan within this lock period. We're going to fund this loan and then hand it over to you for servicing. So if, let's say I have an investor, CIT or Goldman or whoever it is, if I'm locking in a rate, it has to be specific to a property that is under contract, because we're saying we're going to close this within the 45 days in this case. We're going to close it within 45 days. We're then going to deliver it to you for servicing within our, whatever our servicing agreement is. So the answer is no, you can't lock in a rate unless the property's been identified.
So you're saying they are looking this weekend, they're planning on writing offers this weekend. They talk to you, you say you can close in 21 days. They couldn't lock in a rate prior to being in contract when the timing would work.
You can't lock in a rate until there's an executed contract.
Okay. But there doesn't have to be an appraisal yet.
No. You could lock in on day one. If you you go out looking this weekend with your clients and they go under contract and you open escrow on Monday, on day one, on Monday, that lender or bank or broker or whoever could lock in the rate on that day.
And if the rates were to fall through the course of escrow, what would it cost them to change and go with a lower rate?
There has to be, so again, when we're locking somebody in, we're essentially, I don't want to say guarantee, because obviously nothing's a guarantee and certainly escrows fall out, but we are saying to the specific investor that we're going to deliver that loan. Interest rates have to improve really substantially for there to be what's called a float down, or for us to change the lock for the better. There has to be a very substantial difference in rates. And that's the tough part about navigating, especially this kind of market, because you don't want somebody to be susceptible or open to the volatility of the market, because it's on a daily basis. It swings pretty aggressively. Generally speaking, they go up faster they go up quicker than they come down. I don't even know if I've ever done a flow down, to be honest with you.
In this market, with the rate potentially going up, and say first-time homebuyers, for example, through the course of an escrow, if rates were to continue to go up, it may preclude them from buying the house. They may change their debt to income ratio, and they may then not be qualified to buy the house. Do you recommend them locking in sooner so that doesn't happen? Then maybe you would in a traditional market.
Yeah, probably. I mean, of course, everybody's situations and circumstances are different. Somebody that's got maybe a longer escrow period might have a little more time to roll the dice and play the market. Me personally, I don't think it's worth risking the volatility. If you were a buyer that was in the market in January and for some reason canceled escrow or whatever the case was, it all looks a whole lot different now. So me personally, I don't know that it's worth the volatility.
Can I ask a crystal ball question?
What's that?
Can I ask a crystal ball question?
Oh, God.
So my life as an older person, when I bought my first property, the rate was 9%. My sister was 21%, but she was in that rate era. And 7 years later, I sold that property. I moved to LA, bought another house, 9%, 9.2. And it kind of flip-flopped here and there, really kind of hovering in the 6.5% to 7% for a very, very, very long time. You could get as low as 5%, but those were always ARMs. They were not 30-year fixed mortgages. My question to you is, do you foresee the future in your crystal ball of rates stabilizing again where they used to be, or is the kind of 4, 5, 5.5 our new normal? Because we're treating it like it's high. And in my world, it's my life, it's not. It's still incredibly low. So, and everybody says that, but the question that I have is, do you think it's going to normalize higher? Or is it going to be as volatile as it's been for the last, whatever, 10, 12 years?
I do not have a crystal ball, but you must have missed the earlier part of what we were talking about. And
sorry, I don't mean to be redundant. I did come in late, so sorry about that.
No, that's okay. We were talking about, I mean, I don't have a crystal ball. I am certainly no economic genius or guru. You know, I'm looking at information that is available to anybody out there, right? Generally speaking and historically speaking, as we lean into a recession, that historically means that we will see relief from a mortgage rate perspective.
No, I understand that, and I was here for this slide. What I'm saying is, in the long run, I feel like we've been post-housing crash, so say post-2009, we've been in an artificially deflated interest rate market. Is anybody saying in your world that we will, quote, get back to normal, where our rates are 6.5%, 7%, and you're only getting the 5% on the ARMs? Or is our kind of artificially deflationary thing that we've been in since that massive crash something you think is going to stick around? So obviously, you know, wiggling back and forth between these numbers.
I don't. I think it's all cyclical. I mean, do I know, or do I think we're going to get back to where levels that we were in the last 2 years? I don't know about that. And I don't know where they'll necessarily land in terms of normal, but it's all cyclical. And as things move and change economically and in the world, and you know, the war in Ukraine is a big thing that is greatly going to impact goods and exports from that region and area of the world. That is going to impact inflation. So I think all things are cyclical. I think, you know, what is the new normal? I feel like in any sort of cycle, it's either, oh my gosh, it's incredibly low, or there's always a sticker shock factor. I don't know what the new normal is. I think there's always ebbs and flows. I should have pulled like a historical chart on rates, and I didn't.
Well, I can tell you in the 80s, it was in the 19 to 20%. And then in the 90s, it was around 9 to 10%. And then in the early 2000s, it was or late 90s, early 2000s, it was also around 9%. And then it maybe went down a little bit. And then after 2008, all of a sudden it was like nothing. And that's not normal. That's my point.
Yeah. But it's also, you know, the feds are also looking at, as we sort of adjust and acclimate to the current environment, you know, everybody is monitoring mortgage applications, and they're monitoring the data of first-time home buyers and who's getting into properties and all of these things. And as we get further into this sort of period, that data is going to be available. And the reality is that the housing market and real estate and home ownership are a huge contributing factor and component to the US economy. So, you know, I don't know if there is such thing as a new normal with something that is so cyclical. I don't know if that answered your question.
Fair enough. No, I mean, I kind of expected that to be the answer. I'm just trying to put the perspective on it for people. You know,
Yeah.
Ashley's just getting into this and probably, I don't know if she can hear me, she probably work, but, you know, whereas Michelle and I have lived through these varying, whether as an agent or just as a person, you know, we've lived through these varying rates, you know, whereas Ashley, I don't know if Ashley's ever bought a house herself, but she's a new agent, and, you know, for her, 5%, wow, that's high. And my point is just that it's not.
Yeah. No, I agree. I agree. I started in 1998 in this industry. And they were upwards of 10, 12, 14%, depending on.
And that's my point. I mean, I bought my first place in 1992 and it was a little over 9. And I think it was on an adjustable so that I could get that. I mean, I always did adjustables until,
Yeah.
You know, the one that you just did for me, actually. The fixed rate loan, I think I've ever done.
Well, and that pushes us into the next slide here. And I just wanted to quickly touch on that. There's been a ton of articles and stuff in the media lately about ARM loans are making a comeback and things like that. And that's just because they price better than current fixed rate loans. And again, going back to the point that we were talking about earlier, an investor purchasing a 30-year mortgage bond right now, or a long-term mortgage-backed security, in all likelihood, that loan will get refinanced before that investor actually makes their money. That's why fixed rates are pricing a lot higher than an adjustable loan right now. So from an investor standpoint, remember I talked about mortgage-backed securities, just like stocks. Investors are now leaning towards ARM loans because they know realistically they're going to get paid off. They're going, you know, Joe Smith buyer is likely going to refinance. And so these ARM loans are pricing better than a fixed rate loan. So fixed rate, set rate of interest that does not change throughout the life of the loan. I'm sure you're all familiar with these. Typically most makes it easier for homeownership to budget. Nothing changes, everything is fixed for the period in life of the loan. Provides protection from sudden changes in the mortgage. Difficult to qualify if interest rates are high. This is where we're at right now. The incredibly quick increase from where we were, you know, 5 months ago to now, or 6 months ago, has literally kicked people out of the market, or where they thought they were 6 months ago, they're no longer there from a qualification standpoint. ARM loans are not available for all loan types, is another thing to know. They're very specific, not available to every buyer or every program. So just take note of that. If you have a client that, you know, is looking at a $500,000 condo, it might not be an option. But again, it goes back to the whole point of all things temporary, and things are certainly cyclical. So for an ARM, the rates are set below the market rate on a comparable fixed rate loan that rises over time. Typically, it's more complicated than a fixed rate mortgage. I mean, I suppose. It's fixed for a period of time, 5 years, 7 years, 10 years, whatever it is. It's fixed for that period of time. And then after that, it then becomes an adjustable rate. The likelihood that somebody refinances or sells a property within the first 7 years of owning a property is very, very, very likely. Which is also why people are moving into these types of loans right now. They're less expensive and they know that things are temporary. Maybe it's not their forever home. Maybe they're banking on the fact that there will be an opportunity to refinance down the road. It doesn't make sense to take a higher fixed rate term if you can get something at a lower cost. Typically, they're much cheaper than a fixed rate mortgage, at least in the first 3 to 7 years. Again, I don't know what exactly the percentage is, but very high percentage of homeowners either sell or refinance in the first 7 years. Monthly payments can change frequently, making it difficult to budget. They don't change until after that fixed period of time. So, if it's 5 years, 7 years, 10 years, whatever it is, the payments are fixed for that initial period, and then they would then turn adjustable. So it's definitely a hot topic. I mean, you can Google it, and it's all over the place. Any sort of news wire or anything like that related to real estate or mortgages, ARMs are a hot button at the moment, and it's a good option. And years and years and years ago, neg-am arms were a thing. Those are not a thing anymore. So people hear the word arm and they're a little traumatized, but it's because they don't know. They're equating it to the crash of 08 and 09, and these are just not those. So
What about, you got me an interest only loan that was based on sort of a different type of property and scenario. Is that something that our typical clients are going to be availed of? Because it really hasn't been in the last 5 years.
what do you mean, interest only loans?
Yeah. I mean, that's never come up as an option for any of my clients. And I'm wondering, is that something that's going to start coming up as an option just so that they can qualify to get in because the rates are higher?
The thing about it is that whether you're talking about an interest only loan or you're talking about any sort of riskier based type product, the qualification requirement is going to be a lot more conservative. Things like reserves, you might need 24 months worth of reserves on an interest only loan. And the reason is that, from a banking perspective or an investor perspective, in most cases, that buyer is just going to make the interest only loan, and that balance on the principal loan may not come down. And so with that, they increase the requirements to qualify for interest only loans. And they are out there. They are available. There's a lot of options available from that perspective. It's just not everybody qualifies for it. Not everybody's got 24 months worth of reserves. And they're really reserved for higher price point properties. You can't get an interest only loan, for instance, on a $500,000 condo. That's not that cup of tea. So
if you had $1 million property that two people were buying together, one person has no income, really little to no income, but the other person has a reasonable amount of income, but the first person, this is a real world situation, I'm getting here, Claudia. But the friend doesn't have cash, but the first person who doesn't really have much income has a significant amount of cash, just doesn't want to blow it all in paying cash for something. Is that is not an option at that price point to say put 20% down, get an interest only loan if the reserves are there, or is it?
Not necessarily. I mean, it depends on all of it.
Okay, no, I was just curious. I could give you an example on pretty much everything, but I just wanted to start with that one. All right, I'll shut up now.
No, it's all good. And then, so just the last slide, we get asked this all the time. What's the difference between like a movement versus a major bank? And I'll get into a broker as well. So movement, obviously personalized customer service, all of the operations are in-house. We do have the option of brokering out, but for the most part, everything is done in-house, or processing, underwriting, loan docs, funding, all of that stuff is done in-house. And of course, turn times, because everything is in-house, we've got full control over the process, which then lends itself to managing very fast timelines. Major banks, it's potentially outsourced operations. If your client goes into B of A next to the office, they're on Larchmont, the underwriter is not sitting there with the loan officer. Likely the operations staff is not on location. Maybe it's outsourced. The process in general may not be localized, and that can impact things too. I mean, I hear it all the time. Somebody's going through Merrill Lynch out of New York, and somebody in New York has a very different perspective of the California market than somebody that's actually based here. And like Charlotte was talking about too, turn times for underwriting and just the entire process can be drawn out with a major bank, because they're a little archaic and their timeline is their timeline. We have a lot more control over it. If we need to pull the alarm and rescue something in 10 days, we can certainly do that. That isn't an option with the bank. Somebody might get a really smoking hot deal. If somebody's got a ton of money at the bank, by all means, we can't compete with that. We can compete with timelines and get them into the house. And maybe it's something, later down the road, they go, okay, we'll go with movement initially, and then we'll refinance 6 months from now, just for the sake of getting in the house. But if somebody's got a ton of money at a bank, we can't compete with giving away the farm. And then a broker is a third party. Nothing is done in-house. The underwriting depends on the investor that they're sending the loan to. A broker is going to package up your client's file and shop it with whoever they have from an investor standpoint, and then ship it off to that investor for underwriting and processing and loan documents and all of that stuff. The control of the process is out of the broker's hands. It's entirely up to the investor of who they're sending it to. And that's pretty much it. I get asked all the time about the difference between lending institutions and banks and brokers and things like that. So I thought this might be helpful when you're talking to buyers, and they might ask you your opinion on different things. So that's it. Does anybody have any other questions? Hopefully it was a little helpful. There's lots of great sources. And I've started sending out different articles from like Housing Wire, for instance. I have a membership on Housing Wire. I have the membership to that website that I had pulled up the chart on. I'm happy to share different information. I know things are tricky right now. So I'm happy to help any way that I can. If you need to see like a buy versus rent or cost of waiting or any of that stuff, I'm happy to help. No questions? Who's VV Desktop?
Oh, it's me, it's Ben.
Oh.
Hey, Andy. Sorry, I'm on the phone and I'm also seeing your presentation on the screen, the big screen.
Oh, got it. Got it. Cool. Well, I hope it helps. I'm always here if you guys need anything or have any questions. And I'll keep you all posted as things move. Things are obviously very fluid right now. So
Thank you.
thanks, guys.
Great
Thanks for
info.
coming.
Thank you.
Okay. Bye.
Thank you.
Bye.